what we're going to do is to look at another source of finance for the company, is to try to borrow money, okay, from the others, or maybe from the bank, or etc. So, if the company is going to try to borrow money from the others, the company here may try to issue the loan notes, okay, to another party. So, this person here will try to hold this loan note as a proof that the company owes me money. So loan note here may have par value. So let's say, same as the shares, the loan notes may have the par value of $1 each. So the debt holder over here, the person over here, is trying to buy, let's say, 1 million loan notes from the company. The company will have an obligation to pay back this $1 million, a par value of $1 back to the borrower. Okay? Back to the lender, I should say, the lender of the money to the company. Alright, so this is the par value. And also the company may have an obligation to pay the interest expenses, okay, maybe monthly or maybe annually, back to this person over here, back to the lender. Okay, so how can we account for the loan notes, okay, using our double entry, journals, that kind of thing? To best illustrate this, what we're going to do, turn back to your notes. Let's directly have a look at this example called KG Limited. It's the requirement assuming the KG Limited has a year ended 31st December 2012. What's the double entry required to fully account for the loan note? So, KG Limited issues 30,000 number of loan notes. I told you, isn't it? $150. So this is the par value, 10%, which is the interest rate for the loan notes. To the KG Limited will pay for the interest expenses to the lender. Okay, 10% loan note on 1st July 2012. Right. So interest is paid annually, which means interest is paid per year in arrears. What does that mean? In arrears, which means, well, I'll pay you the interest expenses after the year end. Okay, that's the case. This is called in arrears, after the year end, on the 30th of June each year. Okay, so I'll pay the interest for you, pay the interest expense to you at 30th June 2013. Okay, so the question asks us, show the double entry as at the year end for the 31st December 2012. It is not for the 30th June 2013. So if that's the case, we haven't paid the interest expenses to the lender, okay, who lends us the money. If that's the case, well, this is the interest payable by the company. It should account for such a liability figure, isn't it? So, how can we show the double entry then? So, we can immediately, when trying to issue the loan notes, we can immediately receive the bank of $150 at par value multiplied by the number of loan notes is 30,000, okay, loan notes over here, which then gives us a total value or cash that is received by the KG Limited is to be $4,500,000. Credit the loan notes, okay, credit on the loan notes as a non-current liability which is more than 1 year, $4 million, $4,500,000. Okay? So, secondly, at 31st December 2012, the company has to accrue the interest payment, although it's not actually been paid by the company, but it has to recognise it. Okay? So we'll talk about this sort of concept, approved basis, later on. So, just get the feel for that. So 31st December 2012 is our, for the what? For the interest payment is to be $4,500,000 multiplied by 10% of interest rate that the question has told us over here, which then gives us have to pay the interest expenses of $450,000 per annum. Okay, interest expenses, but for the limited companies, it is the finance cost for what? For half a year. Okay, it's only half a year. Multiplied by $450,000 over here, which then gives us the figure of $225,000. And we also have to credit our accruals, okay, as a liability that is to be paid by the company of what? Of course, it is $225,000. So, this is how we account for the loan notes in the F3 exam.